We recently held a webinar to take a look at the trading conditions for the professional services sector during this global pandemic. Alongside Sam Palmer of Pinsent Masons, partners from our professional services practice looked at the many headwinds facing those businesses and considered if this really was the perfect storm.
Good morning, everybody. I think we've got most of those scheduled to join us are online. Good morning and welcome to our webinar. My name is Mark Lucas. I'm a partner here at Quantuma, and my pleasure to be chairing this today. This morning, we're going to be reviewing the challenges facing professional practices during the current climate and reflecting on whether this represents the perfect storm for firms. We're trying to do something slightly different today. We're going to try and make this a little bit more interactive. And we've actually got a short poll, and we'd encourage you to participate if you can, and we'll share those results at the end. To help us today, I'm joined by a panel of experts operating in the legal, restructuring and insolvency professions that advise clients in many areas of professional practice. I'll introduce those to you shortly. Before I do, I would like to also remind you that there's a Q&A function. This is now open, so please do feel free to submit your questions in real time. We've actually had quite a few questions already submitted beforehand. We've allowed 15 minutes to answer these. If we don't get a chance to answer all the questions, then we will send you a response outside of today's event. We hope the technology will work. I had a slight issue myself that the internet went down at home. Someone has managed to cut through a cable outside. But if we do experience any difficulties, please do bear with us. So without further ado, could I please introduce our panelists? First up, Andy Hoskin. Andy is a restructuring partner of mine here at Quantuma and is also head of our London office. He co-heads our professional practices group and is widely recognised as one of the go-to advisors for professional practices facing stress or distress. Our next panellist is also from Quantuma. Delighted to invite or have Sean Bucknell, another of my partners, to join us. He co-leads the firm's professional practices group with Andy, and I think between them can offer a really unique insight into some of the key issues that professional practices face, law firms, and a wide variety of others. Finally, delighted to be joined by Sam Palmer, who leads the professional practices team at Pinsent Masons, leading advisors to professional practices. Sam has over 25 years' experience in the professional practices sector, advising on a wide range of topics, including ethics, professional conduct, providing formal regulatory training, as well as guidance and support to practices, and undertaking independent investigations and regulatory reporting. Sam has also worked in-house with the SRA from April 2012 to 2015, where she headed up the regulatory management team. This supervised the top 200 law firms. And finally, I'm Mark Lucas. I head the firm's corporate finance practice and work pretty closely with my colleagues in a number of situations, both on acquisitions and also where a number of firms find themselves in financial difficulty. Before we kick off, we're going to try for the first time our poll, and hopefully you will see on your screen some questions will appear. So if our technology is working, you will see some questions, and we'll just take 2 minutes, if we can, just to answer those questions with the aim of sharing the results at the end of this webinar. So the first question is really about firms' intention. We're aware a number of firms have had people on furlough. And I think the big question is whether this will lead potentially to a number of redundancies. The next question is surrounding loss of productivity. We're aware, as we are, that we have to put in place social distancing measures. And I think a number of firms are questioning particularly if you are in a building with lift access, how this could impact productivity when people start to return to the office. And the final question is really, I think our audience today is predominantly partners of professional practices. We would like to understand your top 3 concerns as we move out of lockdown and we return to work during June and the latter part of the summer. And we would like to see what is really affecting you guys. So if we just spend a minute just answering those, and then we will hit straight on with the agenda. Today is really about setting the scene, about what's going on, and I'm going to be handing over to Andy Hoskin shortly. We're going to try and bring some of the key issues that we're seeing across professional practices to life in an illustrative case study. And we've also got a summary of what we're seeing in terms of some of the key pinch points that lay ahead for professional practices. The aim is that our presentations will last around 35 to 40 minutes. We will have about 15 minutes for a Q&A and the wrap up by 10:30. So without further ado, if I could hand over to Andy to start the first presentation.
Right, thank you, Mark. Good morning, everybody. I hope everybody's staying safe. When we conceived this idea of the webinar, the whole idea was to talk about professional practices, not just law firms, because clearly the pandemic crisis we've seen affects all professional practices in terms of where they sell to clients. And so we will talk about COVID and the impact on that on the basis of a sort of generic basis, but clearly, you know, it would be churlish of me not to talk about the impact on the law firms in particular, who it's safe to say have, in my experience, probably endured the worst sort of 13 odd years of any particular sector that I've ever been aware of. And unlike Sam Palmer, who is a babe in the wood, I sadly have now over 35 years of experience. So I feel particularly ancient when I discuss this aspect. One of the key things I remember when I just briefly touch upon lawyers, because it's relevant in terms of how I set the scene, is Abraham Lincoln's quote, which was, "As a peacemaker, the lawyer has a superior opportunity of being a good man, and there'll be business enough." And that's the key sentence, really, business enough, because I do feel there will be substantial difficulties ahead. So if I just start to set the scene with a brief canter and go back to the head years of 2008, where I had a full head of hair. 2008 obviously saw the global crisis, as we're aware, and the subsequent real lack of liquidity in the marketplace, which gave rise to substantial difficulties for all professional practices. I remember particularly, whilst law firms were affected, equally architects and surveyors were, as a considerable number of building projects were shelved. And as a consequence, the impact on that particular crisis was felt, as I just touched upon a moment ago, across the whole professional practices front. Turning just quickly to law firms, their sadly difficulties have been elongated because we've had such cracking movements in the law, such as the Lasbo and the Jackson reforms over 2013 to 2015. And we've obviously seen substantial changes in the rates, including additional competition of accumulator type firms. So things have not been easy, and as a consequence, a considerable number of law firms have operated on what I call a very, very tight cash flow, and have not perhaps had the reserves or the resources necessary to endure an aspect of this. So what I'm going to touch upon is COVID-19, the impact to business, and how I think the market or the landscape is going to fundamentally change, but with an emphasis on law firms, no question about it, but nevertheless on all professional practices. So as I talked about, in 2008, we saw a lack of liquidity. predominantly through banks and some of the high-risk derivative trading. I think, sadly, again, you will see now a complete lack of liquidity for perhaps 18 months to at least 2 years. I noticed there was a comment in the Law Society Gazette that the conveyancing feel that furloughing should be more flexible, so firms can draft staff in and out of furloughing to deal with what they consider to be peaks. That comment was also replicated in the Royal Institute of British Architects, who feel that there will be pressure to close projects that were ongoing before COVID. I'm not sure there will be quite the spike in certainly property sales that is being envisaged. Already I'm aware that a number of the high street mortgage lenders are changing the terms, whereby previously they were at sort of a 5% deposit yet again. It immediately seems to have dropped now to 10 to 15% deposits for individuals to acquire properties, and that will seriously undermine property market, particularly when house prices are still somewhat marked. Now, if we were to look at COVID on the general professions, what we've obviously seen is what I call the cryogenics, where businesses have almost overnight become frozen. There have been substantial drops in revenue streams, substantial drops in cash collections, and substantial drops in work in progress being recorded. And this, by the way, is a scenario that I feel firms will need to adapt to. I do think there will be some bounce back, but equally I need you to be clear, in my view, and this is my personal view, but this is me setting the landscape, that you will see a fundamental shift or a dynamic in how we operate and how we sell our services. Client meetings traditionally where one will attend the premises, you'll have a bit of chit chat, coffee, sit down, go through the issues, review documents, shake hands, and then the work will be actioned. Invariably gives rise to higher recorded professional time. Calls, even like, for instance, this indeed Zoom call that we're having is click on and click off, and as a consequence sees chargeable time being shortened. Now that in itself is not necessarily cataclysmic, but what it does require is that additional clients and marketing will need to be done. And there lies the slight conundrum at the moment, because obviously marketing has traditionally been on a personal level, and obviously that in itself will no doubt change. I think the other things that all firms are seeing, and I don't just mean this legal sector but others, is pressures on previously underinvested IT infrastructure, limited IT licenses as more and more staff work from home. The premises, which Mark just touched upon very briefly, is going to fundamentally change. I do note that an individual from Barclays Bank was quoted as they thought that the footfall and occupancy usage of space is likely to be refined by a decline of 50% in the next 5 years, which will clearly be substantial on the basis that I think firms are growing accustomed to the idea that there will be effectively rotating between the office and home of staff, and as a consequence, IT spend will need to be substantially increased. I think the banks are being utilised by the government in terms of their aid packages. So what we call the traditional existing borrowing facilities are likely to be somewhat hampered, and as a consequence, my suggestion would be to those attendees, if they consider that there are or are likely to be cash flow issues arising, they may wish to try and avail themselves of some of the government aid packages that are currently available. Equally, I think most firms have taken advantage of the VAT deferment of a quarter. There is obviously effectively a consensual time to pay being made available, subject to obviously all professional firms making the application, but I understand it is most certainly being granted throughout the period of COVID. But of course, whilst that helps in terms of short-term cash flow, it does mean that there will be longer-term problems with accruals for both HMRC, PAYE and VAT. And that in itself will have a further impact in December when the preferential creditor status is reaffirmed. And that means that the banks will be cognizant of that particular liability when they're having to calculate loan-to-value covenants. If we can move on to the next slide, please. Okay. So touching upon the cash flow problems and the lack of profitability, what you've now seen is you've seen effectively a decline curve being imposed on professional practices through no fault of their own. And it's safe to say that every business of a professional practice level has had a decline curve imposed on it. It does not mean to say where any particular member firm or firm on this call is placed on the decline curve. Some who have been suffering torrid cash flow issues may be much further down the decline curve, and some may indeed be at the top of the curve. The purpose of today is, and the subsequent speeches you're going to hear, is our ability or the proactivity that can be applied in order to try and ensure that firms can weather this storm and emerge somewhat bruised and battered, but still alive. The key issues on professional practices are, fairly intransigent. You have a fixed premises cost, you have high members of staff, you have ever-increasing professional indemnity insurance, you have substantial regulatory costs and compliance. And so the ability for professional practices to contract and expand at will, like other businesses can, is not available to them at this moment in time. So there will be some very difficult decisions that I think will need to be considered by professional practices throughout, architects, surveyors, law firms, and gosh, even though I say accountants even. The current reduced cash collections can be mitigated by furloughing at the moment, but clearly it will have an impact. And whilst the economy begins to reawaken or thaw, some of these issues will now have to be addressed, and addressed fairly urgently and proactively, in my view, by management. If one were to look at the actual issues in terms of returning to work or thawing out the business, the ability to be able to utilize the office as previously was is currently not available to all of us at this moment in time, bearing in mind there is sadly still no vaccine available in this pandemic. And so it's incumbent on us to provide safe working environments. For my firm, with Mark, we're currently sort of assessing it at about a 35% occupancy only. It'll have to be done on a rota basis. There'll need to be safe distancing. There'll have to be enhanced deep cleaning. And, office COVID-19 risk assessments are going to become something that are going to become the norm on the basis that we can't have any particular offices being shut once we've reopened. I think you will see flexible hours of staff working, not just to avoid the necessity of peak hour transport as such, but predominantly to also take into account the fact that staff can work from home. Their IT systems are good enough, and so you will see effectively almost shifts being created in a professional firm and a rota system being commenced. For myself, I think the pressure to maintain home working will always be there. I do think, however, we will be able to operate much more sensibly once the offices are reopened. Law firms particularly require those meeting room spaces for some limited meetings. I caveat that yet again, having spoken to 3 of the 4 clearing banks who have all told me that they consider that their diary is going to be fundamentally changed post-COVID. They estimate that the actual one-to-one or personal meetings that they will have will be probably at 50 to 60% of what they've had previously. They don't particularly wish to put themselves at risk, but more importantly, they consider with the IT systems, it's not particularly necessary. It can be achieved just as easily with a Zoom call or a conference call. What you are going to see is those law firms and I turn to law firms again, being impacted again even further than other professional practices, because it's not just COVID that's going to impact the law firms, in my view. What you're seeing at this moment in time is you'll see that those full service offering firms who have been dependent on M&A, capital markets, substantial high-end conveyancing, all of those are likely to see a substantial, in my view, drop in turnover, certainly over the next 2-year period. Then what I call the smaller to mid-sized firms, who have invariably mixed their general practice with either PI work, including Crim Neg, are going to be equally affected, perhaps by the goodwill tsunami towards the NHS. But either way, the ability to see settlements of that nature are going to be much more delayed. Notwithstanding, I do consider there may be a sort of swathe of filings against negligence and hospitals for failure to provide the appropriate equipment levels. And then to add insult to injury, we're well aware that and it's been imposed on the Ministry of Justice, further changes yet again to legal aid, not least of which crime, is going to be catastrophic, both in terms of the regularity of cash flow payments, but also in terms of the sheer quantum. Now, none of those in itself are terminal, but it does reinforce the theme of today's webinar, which is that management needs to be proactive in dealing with not just preserving cash, but finding alternative sources of cash, and also perhaps having to take some hard decisions in terms of actually retracting rather than growing businesses, and possibly even, sadly, redundancies. So these are sort of the sort of barren landscape as the patient reawakens. It is not going to be a new fertile world, but rather it is going to be a very, very difficult world for the next 2 years. I do think there is hope and there are green shoots. I think I've said it before and I say it again. I do think ABS solutions in terms of a law firm are likely to be arising by virtue of PE houses. I'm also aware that there is at least one substantial major firm of architects that's now having discussions with a PE house in order to provide additional working capital. And as a consequence, I do think those who are proactive will be able to survive. I think those who think that matters will naturally resolve or rebalance themselves, I think could be in for a major shock. And at this point, I think I'm going to suggest that I'll hand over for the illustrative example to my colleagues Sean Bucknell and Sam Palmer.
Just to touch on that longer term view that Andy mentioned, our view is that firms will have to diversify into new work streams over the coming months and years in order they're not over-reliant on one particular type of work stream. Office space, which Andy's touched on, we have seen the office model changing over the last few years with regard to legal practices as they become more agile and less reliant on office space. The onset of COVID has pretty much accelerated that requirement. Staff working from home a large part of the week is going to be the new normal. Hot desking within the office, again, the new normal. That's going to require significant investment in IT. We also see that more agile firms tend to have a lower ratio of support staff and therefore less non-fee earning staff. With regard to LLPs, we're probably likely to see additional capital calls in order to fund the slowdown in revenue. And with regard to PE, we're still seeing continued interest from PE in law firms, even post-COVID. So PE have expressed a significant interest in acquisition opportunities. And if we just hand over to Sam for the nuances.
Thank you, Sean. So really, I mean, in terms of the law firms, obviously we've got a highly regulated sector. We've always got those pressures in terms of the use between those client and office monies. Very often they can become mixed payments paid into office that need to be very quickly swept out to client. it's the really only sector where we've got the regulator having such powers of intervention, statutory powers, and then those circumstances, obviously we see any value in the business really melting in effect like ice cream. In terms of also that sort of highly regulated sector, we've got additional COVID-19 challenges and this applies across all the professional practices sectors, obviously all around client confidentiality, all around GDPR, working from home type issues. Also, in terms of law firm, particular nuances, we've got the SRA's statutory charge, the statutory powers under the Solicitors Act, and what that really means for lenders in terms of those charges being trumped by those regulatory statutory powers. And if we could just turn on to our next slide, in terms of looking at, if you think of the sort of the classic professional practices timelines, this really is the sort of typical calendar that would apply across the board for law firms. Now, there have been some changes, if you like. August, instead of seeing us perhaps in Tuscany this year, is possibly going to be more of a stay vacation. But this is the classic financial year for professional practices with some fairly lumpy payments and some fairly lumpy cash flow spikes. We see typically, if you think of an end of April year end for most professional practices, we see May, if you like, as the new year. We've seen that total bill out in April. May is typically a new year. Of course, in this current climate, then we've seen a tough year end as well for many professional practices, with the COVID lockdown occurring obviously in March, just before that last sort of 6-week run up, which for most professional practice firms is obviously a peak revenue time. June typically is seen in a normal year, if we ever return to normal, as a sort of almost, I've called it R&R, but that sort of slight feeling there's been a massive bill out, everyone's got the whole year to sort of catch up. This year, of course, it's exacerbated even more with the remote working, the sun is shining outside, we've had a series of May bank holidays. July is always the partner's tax, and I know that there's a lot of debate in professional practices, very live at the moment, around whether to defer. And I know in Andy's intro speech, there was the point there about, is that just storing up trouble? When I talk about deferring that July partner's tax, obviously it's going to make a double payment in January, that sort of double bubble effect. How is that to be funded? I know there's a lot of partners who are anxious in circumstances where obviously distributions are not happening, drawings have been significantly cut across the board, that the partner's tax, of course, is always that personal liability. As I mentioned, typically in previous years, we might see August as a time when people are away. This year, we're going to see very different terms of holidaying. But I know also that professional practices need their key workers, need their staff to take their holiday during this lockdown period as well, getting ready, if you like, for those busier return to work times later this summer and early autumn. I've called that September back to school ? Of course, I know that's all being very hotly debated, very up in the air. If you think about it in our professional working terms, so usually September is a time when people are waking up from that sort of, we really have got to crack on with potentially poor Q1 results. Now, this year, we're going to see, of course, the PII renewals and the legal sector, the PC renewals in October, particularly cash critical. We're not going to have seen that big cash collection bounce in those early sort of May, June that usually follows the end of April, the end of year-end billing. Because of the COVID effect. So we're going to see, although November and October are bumper months typically for time recording, it's always that cash lag. That January partner's tax point, again, as I mentioned, this year could see the double for any firms, and I think there are many from a cash flow perspective who are considering seriously deferring the July partner's tax. February is always, unfortunately, one of the highest months of the year in the professional services sector for pre-packs. Now, that is because the cash issues that from the summer, in effect, stored up, come to bite January, February time. Typically, that January tax partner hurdle is too much to get over for firms that are struggling, was struggling before they went into COVID-19. Again, we see the pattern then on a financial year end of the end of April, usually with the billing foot to the floor. And then I've sort of colloquially referred to it almost as children in need, is what we've seen typically in the April billing month. Firms don't see that sort of steady revenues across the 12 months. We always see that end of year spike. And again, that is what has been so impacted by the timing of the COVID this year for many professional practices. If we can just go on to look at our next slide. This is just a very quick headline, if you like, of some of the many law firms, in fact, that have required a process to compliantly close. No interventions, but obviously in the public arena. If we can move to our next slide, please. Sean, if I could hand back to you in relation to our LLP case study for this morning's discussion.
Thanks, Sam. So this case study has been invented. It's not a real practice that we've dealt with. It relates to an LLP. It can be worked in respect of any type of LLP. This example is a law firm, but it could be a firm of surveyors or a firm of accountants, all of which have the same issues, i.e. they operate a client account, have professional indemnity insurance, and have a third-party regulator. This particular firm turns over 20 to 25 million, has 20 partners, has a central London office and 2 regional premises. It's a mixed practice. So what are the issues? Well, in this worked example, 3 high billing partners left the firm about 12 months ago to join a competitor, and it took a number of fee earners with them. This was well publicised and has been slightly destabilising for the firm. Whilst the firm made 2 lateral hires, these have been costly in terms of recruitment costs and take-on packages, and the lateral hires have not performed in line with expectations. There's been a decline in turnover, coupled with the capital call from those departing partners. Other partners have become restless and have indicated that they're not earning the money that they think they should be earning, have been tapped up by recruitment consultants, and have indicated that they would also like to leave. Coupled with the above, the firm has also had a number of insurance claims against its professional indemnity policy over the last couple of years, 2 of which have been quite significant. The firm has been going out to market to get renewal quotes. These have been limited in number, and also the limited number they've received have been significant in cost, and that cost can't be funded out of existing working capital. The rent-free period in the office, in the London office, has expired 12 months ago, and that is now increasing on an annual basis. When it came into lockdown, all existing facilities were nearly utilised, and obviously post-COVID lockdown, with various service lines not performing, working capital has been limited. Its lenders have indicated that additional lending and support is available. However, it would require the existing members to provide additional capital and or provide guarantees. So the outlook for this firm is challenging, and what we're going to discuss is how this can be navigated. I don't propose to run through any of the issues surrounding how we would transact, more what can be done to keep the firm on track and avoid an insolvency. The first key point that we see is stability. Stability and confidence in the partnership group is driven by the managing partner and the executive board. So the partnership must be stabilised and all partners recognise the issues and work together as a whole. What we can't have is individual partners following personal agendas, because that is destabilising for the firm, and if more partners lead, it leads to a cycle whereby turnover walks out the door, the capital requirement to be repaid to those partners increases, and effectively the firm would then move to, unlikely, an insolvency event. What we also see is early engagement is key. Typically, members of an LLP feel more empowered when they are part of the firm and decision-making process. It's common for the executive board to manage that decision-making process and not to filter down to the other members the key issues. So early engagement for all partners we see as a critical piece, so that they understand the issues and can understand exactly what needs to be done. Early engagement should also be extended to the key stakeholders, such as the business's lenders, so that sensible plans and additionally external advisors can be brought in order to put those plans into action. A key strategy needs to be developed. Cash is king, and the firm needs to operate a detailed cash flow to understand the various cash spikes in the business calendar. Sam's touched upon those, but typically payment of partners' tax, professional indemnity insurance, and VAT and rent quarters. Cost cutting needs to be undertaken. The cost cutting, unfortunately, can be quite time consuming, given that it's quite difficult to implement certain cost cuttings in an LLP. But where leases cannot be broken, you can consider things like subletting office space. You need to consider redundancies and how they can be funded. Another thing to look at is whether there is any merger opportunities. Typically, merger opportunities do provide cost savings, and it can also re-engage members and staff post-merger. Two final points, which are normally considered to be quite mundane, is IT and archiving. Whilst IT investment at this stage is likely to be costly, the move towards fully remote working and electronic files is now more necessary than ever. We commonly see in large legal practices legacy archiving as barriers to transactions on the basis that the acquirer, albeit a merger or via an administration, has to pick up the cost in respect of destruction and ongoing archiving costs. If there can be a move to e-files, then obviously that cost is then pushed out over a longer term. Sam, do you want to touch on the regulatory and business structure planning?
Thank you, Sean. Yes, just to absolutely reiterate, Sean, your point on the case study, many of those issues are prevalent for every law firm, every professional sector, and we really see the partner group staying together as a key aspect of that early stakeholder engagement. In terms of getting ready, if you like, for taking advantage of opportunities, and also looking at the sort of new world post-COVID, really one of the key things we'd be saying is alternative business structures for law firms are much more flexible in terms of external investment than the old-fashioned, really recognised body shape. I would always be recommending that law firms have, as it were, a spare. That is, they might want to have an entity in the cupboard, as it were, that isn't immediately trading, but is there to be used potentially on an acquisition at short notice to take commercial advantage. They might be seen, as I've badged it there, colloquially almost as HMS opportunity. It might be that an acquiring or a consolidating law firm thinks that actually they might sort of long arm an acquisition and keep that in a separate entity. Alternatively, of course, it's always there as well in that lifeboat type scenario, or potentially for an MBO sort of prospect. Again, as a clean vehicle ready to transact, is a useful tool to have in the kit bag in these times to take advantage of opportunities as well as face challenges. One point we've mentioned there, regulatory mapping. And again, in the legal sector, I think it's fair to say that law firms have traditionally retained all of their service lines within the main LLP, the main entity, whatever it is that's recognised and authorised by the SRA, whether it's a recognised body or an ABS. And in fact, many of the legal services that we provide today, in fact, are not the defined reserved legal activities. There is an opportunity there for law firms to consider a separate entity with a lighter touch regulation, a separate entity which might be, say, an advisory arm type of model, a consultancy arm sort of model, which can have different arrangements for PII, different arrangements in terms of some of that compliance cost that Andy mentioned earlier in his introduction. If we could move on to the next slide, thank you. Just for a moment as well, I know there's been a lot about IPOs and opportunities potentially for the future law firm funding. We're aware of a number of the firms that we work with as well in the professional practices. This is also being, firms are getting ready, preparing for doing that consolidatory, that acquisitorial work in readiness also to list. If we could have the next slide up, please. Mark, may I hand to you? I know we've got the poll results coming up.
Just before Mark, you come in, Sam, just 2 points. Number one, your last slide, just be clear, everyone. Pinsent Mason's logo at the bottom right of the slide does not indicate that they're likely to be floating in the next 12 to 24 months, because obviously you had Taylor Rose, Phil Fisher, Owen Mitchell, and then Pinsent Mason, Sam. So I just want to make sure there's no confusion there. And the only other thing I wanted to add on is, for those who are of a lawyer nature, it may well be worth considering the utilisation of an ABS for legal aid contracts at some point, so that or even PI work can actually ring fence from the main client work. I only say that as a suggestion in terms of preserving the main practice from areas of the law which could be turbulent in the future. Anyhow, that's enough of that. Over to you, Mark.
Thanks, Andy.
Thank you. Before we go to Q&A, and we've got quite a number, which I don't want to bite into that, but for me, I mean, I think the key takeaways probably applying to professional services along with a big chunk of the economy is really make sure that you have a clear plan and you understand your finances. And I think time and again, we quite often come across firms where management information is not fully up to date and there isn't a strong financial forecast. And maybe not one for now, but one of our firm recommendations is to make sure you have a 13-week rolling forecast as well as something that looks out for the next 18 months. I think one of the themes that's come through, and again from some of the Q&A, is our view is very clear. You should take early advice if you anticipate any stress or distress. Quite often, taking that advice early will stop stress becoming distress. I think key is developing a communication plan for key stakeholders, and we've had 2 or 3 questions about the timing of how you communicate, and particularly with the regulators. And I'd like to just, in a moment, sort of dive a little bit further into that with Sam. And I think the other thing is we are still seeing acquisitions going on, both in legal practices, accounting, other fund managers, property agents. And I think if you're one of those firms that's going to get onto the acquisition trail, is to get yourself ready and funding ready. And there are a number of sources of funds available to do that. I'm waiting for the poll results to come through. I think our poll is now closed. A good number of you have participated, so thank you very much. The guys behind the scenes are going to collate that, and I hope to be able to share that with you shortly. One of the first questions I'd like to ask, as a business, we've already cut partner drawings. A number of partners can't afford any more. What will be the bank's view when we are likely to end up with overdrawn partner current accounts?
That's a very, very good question. My view is the banks, in my experience, are aware that there can be overdrawn current accounts. They're well aware that partners can't exist on thin air. And as a consequence, they have been supportive of reduced drawings. Certainly when we've been doing effectively monitoring for the banks, they are cognizant that effectively debtors are being created by overdrawn current accounts, but they're well aware that that will have to be worked out over a period of time. So to the person who asked that question, engage with your borrower. They will not be surprised at your position, and I don't believe it would impact dramatically on your particular business model. Clearly, what it is likely to see is a non-reinstatement of your previous levels of drawings as you redeem your overdrawn current balance, but it would provide a regularity of income, in my view. I was just going to say, I thought Alison Goldthorpe, who's on, asked a particularly pertinent question. We've seen a number of changes to the insolvency regime, including the creation of effectively now a moratorium, which is supervised by the insolvency practitioner. And Alison, this may be something that Sam can elaborate on, was asking what is the SRA's view. I think Alison's point is it's untested. From where I stand, it is particularly relevant. I think there are, Alison, 3 things that are key on this. Number one, what would be the risk status for an insolvency practitioner during the moratorium where the law firm is continuing to practice? Number 2, how would it be proposed that a non-lawyer would be able to be acting on a moratorium when they could have access to effectively client matter or confidential data? And again, I haven't seen the rules surrounding that to see how that could be bypassed. And then finally, Alison, you're absolutely right, whether it's then a question of whether the SRA provides some comfort. I am somewhat reassured that there was a memorandum of understanding signed between the Insolvency Service and the SRA, and I think it was November 2017, which allowed both regulators access to certain information. So I'd be hoping that perhaps that particular point could be tweaked and expanded upon. But at this moment in time, I don't have anything further to add from your very pointed and very relevant question.
We've had another question whilst we're scrolling before I get to some of those submitted in advance. There's a question, are you seeing issues with partners' loans being triggered as partners exit, but where the firm can't repay the capital, or where there is a mismatch between repayment of the capital in the firm, LLP deed, partnership deed, or shareholders agreement, and the obligations to repay under the loan agreement? Do you want to take that, Sean?
Yeah. I mean, what we see normally is any partners that leave, the firm would normally come to some agreement for a repayment over a period of time. Typically, where large amounts of partners exit the firm, then the firm needs to be recapitalised. So when I talked earlier about partner engagement, partners need to be brought on board to understand what the capital requirements are and to go and speak to their lender. Typically, we've seen a number of instances where partners have had to inject more capital. They've also brought on more junior partners in the firm up to higher term limits. So effectively, they're injecting more capital into the firm, or they go and take third-party loans in order to repay those partners. So there are a number of options that are available.
It's a very good question, though, Mark, to elaborate, because actually we had seen this before COVID. We've seen this particular issue raise its ugly head on one particular high-profile failure, and it's been very interesting because there has also been a dynamic as to whether overdrawn current accounts, once established, could be then offset on fixed capital accounts. And obviously, we come to the conclusion it couldn't be, but it is of particular relevance to those partners who have left previously. So we have already seen this, and I think all I'm going to say is I think COVID will further push this point exponentially because of the difficulties raised by the previous question in terms of overdrawn current accounts already during this very difficult period.
Very many partners who sign up in terms for their capital injection into a firm seem to, put a lot of weight on the fact that the firm typically, meets interest, and there's usually a provision that the firm repays that loan within a certain period after a partner departing. Ultimately, the professional practice loan always sits as a personal liability with the partner, and it's typical that we see quite commonly is that the banks, for example, under the terms of the loan, are wanting to pursue the individual partner on a personal basis, unlimited on that in relation to that PPL, and there's that gap in time, or as you say, there might have had to be an event, or the firm it hasn't simply got the cash to repay it. Ultimately, the buck stops with the partner, and there we have also seen historically on some other law firm disputes, significant on-running inter-member litigation, some which probably doesn't help anybody. But that is a key point for all partners to bear in mind, is that ultimately the liability for the PPL repayment sits with them. There's a lot of overconfidence, I think, initially on when those documentation is properly completed and somebody's being welcomed, as it were, into a partnership about what that actually means.
One that was sent in before, Andy, and I think this might be for you. How can we renegotiate our premises lease with our landlord? We don't think we're going to need the inner city space that we've signed up for quite recently. Are there any tactics you would recommend?
Yes, there are. I think obviously consensually is always the best way to do it, but and I'm not for 1 minute advocating it. There should be the nuance of an insolvency to avoid that, but in all likelihood, and particularly during this period where everyone's supposed to, forgive me, hashtag be kind. I think there has to be some sensible dialogue. I mean, there is another question that obviously the debt could be compromised over a period of time in terms of being able to agree a price to exit before, I'm presuming before occupancy, Mark, would that be correct? They haven't yet occupied the premises?
Well, it doesn't. The question doesn't say that. My sense is that probably they are, but like many of us, they're just questioning the need to continue to have that space, given what is, we're all working from home at the moment.
Yeah, I mean, I think it's a very, very it's a very good question because of what it asks behind the actual question, which is simply this: are institutional investors in premises going to be benign in terms of losing the tenanted income on the traditional lease model? And I think there will be, again, a big dynamic in the market. I think they will have to give way, the institutional investors. I think the days of 25-year leases are not going to be in existence. And I certainly would be surprised if they couldn't exit those premises, whether it was on a sort of traditional sublet or whether even they have to pay a sort of small reverse premium. But I would have thought now is the time for them to insist. Of course, the threat of insolvency on a profession which is being besieged will not have escaped the landlord, and as a consequence, unless guarantees are being given, I think the landlord should be sensible in terms of negotiation. We've always found that to be the case.
Okay, thank you, Andy. Unfortunately, Sam looks like she's not been able to rejoin us, but another question that has just come in. It appears that the use of insolvency law to protect law firms, this helps the SRA. It could mean that a badly run law firm can be protected. Does a pre-pack affect owners' lawyers' ability to hold office again?
Mark, I'm happy to answer that. In short, the answer is no. Once post-administration, the members would have to, on their annual return, note the fact that they've been formerly a member of an insolvent entity, but there'd be no restrictions on their practicing certificate, so effectively they can still hold office. The only time when that wouldn't be applicable is when there have been any wrongdoings in the firm prior to the insolvency, such as any shortfalls on client account. If we've seen that and that's been material and hasn't been rectified on discovery, we would have to report that to the SRA, and the SRA can then have a look into it. But typically, post any insolvent event, as long as the firm has been run in accordance with how it should be run, then there is no effect on the solicitors or owners' ability to hold office again.
Okay.
It will obviously affect the renewals. Because once a firm goes into a process, they don't automatically get their practicing certificate renewals.
Okay.
It's thrown out the system, and it's going to be a manual application then, which can delay things. But other than that, no, they're not penalised as such.
Okay. I think this may have been answered during our presentations, but I mean, are you giving any advice where you see the greatest period of peril? A number of firms are taking action for short-term cash flow, but is there a moment that you think firms are facing the greatest peril? I think we had a useful timeline early on. Is there anything more you could add to that?
I think I mentioned about the cryogenics before. I think we will see a thawing in the autumn, but I think the real problems will then loom from the end of November up to sort of March, in my view, for both tax, for VAT, the establishment of preferential creditors. And also, I don't think the market will be there. That was there prior to COVID. We've obviously now going to look at some sort of recession. Taxes will obviously be increased because of the sheer level of state or sovereign borrowings. And as a consequence, therefore, the ability to sort of re-establish a fully functioning business isn't going to be there, not through any fault of your own, but by virtue of sadly the global economy we're in. I would urge people for that period looming up to do their best to try and get their finances in some sort of position whereby they can weather the storm. I mean, no, Mark, you're going to touch upon this, but the utilisation government aid packages, I think, would be of huge help. I know, CBIL loans you can touch upon, and also bounce back loans, but where there are effectively government aid packages, which would at least protect both the institution and the firm, particularly from the nuances of sort of preferential creditors or valuing a firm's debtors and work in progress, loan to value covenants. I think now is the time to act. The whole ethos on today's webinar is everyone on the call is probably aware that professional services are facing a bleak time. I'm not saying cataclysmic, bleak, but now is the time for proactive management and not what I call ostrich sand management. These problems will not go away. The quicker you address them with your partner group, the quicker you can ensure that firms will survive.
Does the panel know what the view of the SRA will be on the use of the new moratorium procedure for law firms?
Thank you, Mark. Yes, it's a very interesting question, and of course highly relevant in this sector. And the first point really is to make clear is that the SRA has its obligation to fulfil its regulatory objectives and won't provide what you might think of as safe harbour to law firms. So it hasn't expressed a view, and it's unlikely to share any view in terms of that moratorium procedure. Part of the question might also be around what is the position for law firms in terms of their obligations still to continue to manage their financial and strong governance position, and that always remains in place. I think the SRA have made it absolutely clear that there's to be no reduction, as it were, in regulatory responsibilities of individuals and firms, despite the additional pressures of COVID-19.
I think we've just had one question that's come up, and also one that was sent in earlier. We're a well-funded firm. We see this as a period of great consolidation opportunity. What sort of things should we be getting ready in advance for acquiring other practices? And I think that dovetails to one of the questions we've just had through as well. What issues should we consider if we're buying a law practice through an administration process? Is that one for you, Andy, or is that one for Sean?
I'm happy to take that. I think if anyone's looking to be looking to acquire any law firms, what they need to do is effectively have their acquiring entity ready. Over the last few years, we've seen acquirers come to the table, but they don't have a regulated entity in shape ready to transact. So we would say to go and get your ABS insured, regulated, and effectively oven ready, so that you can transact at short notice. ABSs can take sometimes a significant amount of time to be put into place. There can be delays at the SRA, and therefore the quickest way to acquire an ABS is to go to market and to buy one, but typically they can be thin on the ground. So it's really understanding what type of firm you want to buy, how that acquisition is going to be funded, but also to have your acquiring vehicle, your ABS, ready to go so that you're primed to transact at short notice.
I mean, expanding the question though there, Mark, on which vehicle is utilised. I mean, the sort of three key issues arising are: number one, don't be naive. Too many firms go to acquire a law firm and assume there will be 1 + 1 will equal 2. It won't. 1 + 1 will end up probably being worth 1.4 to 1.5 maximum. So as a consequence, when you're looking at cost savings, that will be key to see whether the dynamic means that the actual acquisition can work. Number two, how are you going to fund acquisition? Too many acquirers historically have done it through full debt and not necessarily even PCLs. As a consequence, that burdens the model with an artificial level of debt with an insufficient level of retained turnover. And then finally, which is a very pertinent question asked by Gordon, which is about partner lock-in. Now, it's absolutely key that the higher earners on the target law firm are retained. They will normally be the better paid. They will therefore normally have is hoped a more substantial current account as well as a capital partner's capital loan account. Now, they are the ones that are traditionally have to be taken over One applies to the partnership as a whole in terms of partner lock-in, and lock-in can be achieved, addressing Mr. Gordon, in two ways. Number one, in a benign manner, because they are likely to be repaid their current account at some point, or alternatively, they will be receiving their funds for the partner capital loan to be repaid over a period of the lock-in, normally 2 years or so. The non-benign way is whereby there is likely to be a substantial overdrawn current account, and frequently the purchaser will take that overdrawn current account, having it assigned to him as part of the sale consideration, and he'll agree a defined good leaver, bad leaver, whereby that individual will be offered a lock-in for, say, 2 years, on the basis that that current account will be effectively wiped out, and that's how you can keep the partner team whole. So they are generally effective, to answer Gordon's question, subject to how big is the partner. If the partner is a very, very big hitter, he may consider he can get himself a golden hello from another firm and become a bad leaver. But in my experience, out of all the law firms I've done, I've only ever had truly one bad leaver, and that was for non-financial reasons.
Do you see a role for platforms and fee share models to enable firms to reduce regulatory risk, restructure, access technology, and continue prior to an insolvency process?
Yes, Mark, candidly, I think in the post-COVID-19 world, the firms that we're going to see, the business shapes that we're going to see really succeeding are going to be much more agile, much more light of foot, fleet of foot than perhaps some of the historic law firm model shape. So the older style of a large number of partners, probably heavy property obligations, lease commitments, and so on. And that, that sort of fixed share equity partner model is probably not going to be the most successful shape going forward. There is, I think we touched on earlier this morning on one of the business structure slides, an opportunity in terms of regulatory mapping, and I'd be saying really that every law firm should currently review what work it undertakes that is actually reserved legal activities. There's a great opportunity really with the introduction of the changes to the compliance and conduct rules, if you like, the standards and regulations that came in November 19, for law firms now to have their individual solicitors regulated in a non-SRA entity, in other words, an advisory type body, and to have the reserve legal activities sitting in the core business, the SRA regulated business. Many advantages of that, not least around that whole reducing regulatory risk, reducing regulatory cost, reducing regulatory compliance type burdens, PII arrangements, and so on. I think that the new model is going to be more fleet of foot. The COVID-19 has evidence that we can all work remotely very successfully, and I think it is going to be those businesses that do really look at accessing and making the most of technology and reviewing their current structure shapes that will come out of this all the stronger.
Thanks, Sam. I'm sure, as you've identified, post-COVID, the world is going to look different. And I think if we look back and see how firms have adapted, it's been amazing, really. I think we've got to wrap up, but there's one very practical question that has come through, which I think a lot of partners will be considering. We have a lot of cash headroom. Should we make the July tax payment, or should we just hold off to preserve our cash? My own view is I would always hold off, but I mean, do you guys have any contrary views, Andy or Sean?
I actually think, but on the basis it would be a reduced payment on accounts anyhow because of the sheer impact on profits. It may even be all but sort of wiped out. I would endeavour to try to agree the reduced amount. I certainly wouldn't pay the full amount for the reasons that you very validly said, Mark, because the cash flow drain in a period where we're still effectively frozen. But if one can negotiate a de minimis payment on account so that we've been compliant, that would help us hugely if we were to have further Crown issues looming and possibly needing time to pay. So that's why I'm saying it's a balancing act, but I would err with what you say, Mark.
Yeah, I mean, it's obviously a personal liability. Anything you'd like to add to that, Sam, from a legal point of view? This is where partners potentially would leave cash in the business just for a rainy day and defer paying their July tax payment.
Yeah, thank you, Mark. I mean, I understand that obviously the vast majority of firms use, in effect, the partner's tax reserve as a working capital facility. I think one of the concerns this year, particularly, and a lot of firms would be very topical, Mark, considering whether to make that July payment, obviously it's a payment on account, or whether to defer, which is an option, and in effect you sit on the cash, if you like, in the firm. And I think there's almost potentially a conflict between the partners' personal positions and the firm itself. Candidly speaking, the partners obviously of many firms are seeing, as we've seen on our poll earlier, Mark, we've seen obviously drawings cut, distributions halted in its tracks, all very sensible cash reserving steps, the right things to do. I think the point about the partner's tax is that unfortunately, I mean, Andy and Sean and I have sat in too many rooms with the partner group facing a process where it has been news to the partner group that the liability for the partner tax ultimately is a personal liability. And so here I'm anxious really in the work that we're doing and talking to a number of professional practices about those partner pressures. We've heard earlier this morning about needing to ensure the partner group stays together, keeps that collegiacy. It may be seen as a bridge too far for some partners in terms of also, if you like, putting their tax reserve into the cash pot. Ultimately, obviously that is a defer, not a no need to pay. And then there is that double bubble point, as I mentioned earlier as well this morning, with then January 2021, the July and the January tax. It may be that firms ask their partners individually what their preference is, and some partners may well decide to support, as it were, further and put their tax reserve in the working capital pot with the business. Other partners may prefer that actually that July payment on account is made now. Even as Andy's mentioned, of course, Mark, earlier, there's likely to be a reduced amount because of anticipated reduced profits with it being a payment on account.
Yeah, thank you. I mean, I guess cash is always going to be king, but it just, in a way, if you leave it in the business when it could be made, it is almost like another cash call, and you've increased your partnership exposure. So that is going to be a tricky issue for a number of firms. Thank you, Sam. Ray, we're going to have to leave it there. I wanted to just very quickly share the results. Thank you to all of those that completed our survey. We've had a very good response, and we will make these available to you. But just so that we can share, the first question is: will firms make those staff currently on furlough redundant when the furloughing ends? 25% of you do not have any staff on furlough. 34% are considering redundancies. 3% are considering making everybody redundant. And 38% are not considering redundancies as people come back to work. The next question is: how high will be the loss of productivity that people are budgeting for? Up to 10% is represented by 49% of you. Up to 20% is by 46% of you, and more than 50% is by 4% of the respondents. And some of the key issues that people are facing, we've tried to summarize this. 68% have already or are about to consider cuts in partner drawings. 39% of firms are considering deferring partner tax liabilities this July. 49% are considering delaying special draw or partner distributions out of past profits. 15% are considering a partner capital call. And 18% of our participants are worried about partner defections. I think that's some very interesting data about the state of professional services. Can I thank our panellists? Can I also thank all of the participants for joining us? Our next webinar takes place next Friday. We would be delighted if you could join us for that. It is about how the UK government are helping with the recovery. That will be at 9:30 Friday next week. Please do join us, and thank you once again.
You can find out more about how we advise businesses in this sector on our website.